Hi, and welcome back to Channel 11. I'm your host, Ken Shinoda. Today is Thursday, February 5th, and we're going to talk about market divergences, finally seeing some rotation in equities. Here you can see the land of gains. S&P's kind of been going sideways after a big run-up from the tariff tantrum in April of last year, and we had a big rally kind of into the fall, and we haven't really made much progress on the S&P. But as we look year to date, yesterday's winners, infotech, growth, financials, kind of the laggards in the old school sectors, the Dow Jones type sectors, energy, materials, industrials, value. That's where the rotation's happening on this thought of global growth picking up, especially in the US. We're finally seeing manufacturing PMI north of 50 for the first time since 2022. You got the big, beautiful bill. You got potential tax cuts coming from that. You've got the commodity complex that had been on fire with the thought of a pickup in global growth, not just in the US. You've got fiscal stimulus in Japan. You got fiscal stimulus in Germany. We'll talk about all that stuff throughout today. Here you can see equity performance. Dow Jones, the top performer, 11%. Tech-heavy NASDAQ down 1.4%. S&P kind of sideways. And the non-dollar equity markets doing better. A lot of these European and Japanese markets in Nikkei, not as much tech, more industrial, which is one of the reasons that you're seeing solid performance. Also, that dollar weakness that we've seen. Russell 2000, small caps, a lot of these companies have been underperforming. Some of these mega cap tech and large cap companies and parts, I think, of the small cap, mid cap universe. If we do see a pickup in growth, they will be beneficiaries. They've lagged, their valuations are lower, the PE multiples are lower, potential for earnings improving there, and the market's trying to rotate into these sectors. Here you can see Mag 7 kind of going sideways and down a little bit. Really haven't made much progress since, again, that fall of last year was when all that stuff peaked, and it's kind of been going sideways. Let's look at market cap versus equal weight. Market cap was winning again until October. It's like somebody rang a bell and the market started rotating, and we're seeing these divergences. So equal weight outperforming all the stuff that's been lagging. Looking at Bitcoin, some of the speculative trades that we've been watching. Bitcoin is an interesting story. It's now actually today broken down sub 70K, and it was somewhere where people flock saying it's the new digital gold. Meanwhile, gold has been on fire and Bitcoin's been falling. Dogecoin also down. So it's been this big divergence where Bitcoin is not working as that debasement trade. Gold has been working, and you can see just since October or even October of 23, this kind of exponential rise in gold, silver playing catch up with it. Silver going parabolic. We talked about it last Channel 11, how usually when you see this parabolic move in silver, there's usually a pullback. The ratio of gold to silver was basically the highest ratio of silver relative to gold since the Hunt brothers cornered the market in the late 70s. And I'm not really surprised you saw a pullback all the way up to almost 120. Now we're sitting here in the low 70s. So really big pullback in silver. I wouldn't be chasing silver here, trying to buy the dip. I think you could see more weakness there. I think a lot of positioning has shifted to short silver. But if gold drops a little bit more, maybe that's an interesting buying opportunity. There's still more long-term, I think, reason for gold to be owned by central banks. But silver is a way more speculative instrument, and I could see some more weakness there. Here you can see, again, a big divergence. Semiconductors, data AI infrastructure build will benefit these chip companies. Meanwhile, if AI becomes so prominent, do we need software companies? Will all that be done by AI? And so you saw a big valuation peak in 2024, kind of a sell-off into 25, a rebound. And this has been one of the biggest topics today is this basically crash in the software market. Some of these companies probably a little too oversold. Maybe it's an interesting time to try to take a look at some of these companies. Dan Ives from Wedbush was on Bloomberg radio this morning. I was listening to him. He just mentioned a couple names like Microsoft, CrowdStrike, and Salesforce, and things like that. If they go down a little bit more, but they're still going to be around in the long run, maybe that's something interesting to look at. The Trump trades, those small caps rip roaring back with the big beautiful bill. Financials also doing well with the rates falling on the front end, steeper curve. Dollar initially strengthened into the view of a strong dollar, but now Trump says he doesn't mind a weak dollar. And so you've seen some dollar weakness. We've talked for the last couple of Channel 11s how in this high 90s area, the dollar's down so much from its 110 peak that it's kind of hard to get short here, especially with a new Fed chair coming in that could be a little bit more hawkish. And so I would be wary of trying to press too much into the dollar shorts here. The 10-year yield heading back higher with potentially that hawkish Fed. Maybe we're done hiking. He's more worried about balance sheet, and maybe we should decrease the balance sheet, which could hurt long end rates. International equities, something we've talked about over the last couple months. Maybe something interesting to add to portfolios with that dollar weakness. Also, these indices lagged the U.S. indices. And as I just mentioned, a lot of them have more of that industrial type names that have cheaper valuations, and the market seems to be rotating into them. So I think this is going to be a continued theme of international equities being an important part of a diversified portfolio. It didn't work for many, many years, but now I think it's something we should all be adding to our portfolios. As part of that Make Europe Great Again, or MEGA, you can see that it worked really well to the start of 2025, had a little bit of a pullback as the U.S. played catch up coming out of that big rally from the April lows. And now as S&P goes sideways and Europe continues climbing higher, you can see that those European indices doing better. Here's that dollar chart again, getting down to the kind of this 97 area. I think it's going to find some support there. And I wouldn't be pressing into shorts right this second. If we rally back, maybe $3-4 back up to north of 100, maybe that's a better entry point. This is showing the euro and dollars. Looking at the euro with the last Trump election is just uncanny how similar this looks. This kind of makes you think that maybe we'll see a little bit more of a euro rally. But again, this is just putting two lines on top of each other. So it just happens to be a coincidence. I wouldn't use this to trade. It's just interesting to look at. The yen, it got really cheap again in that kind of 155 zone. When we saw this yen weakness, talking the Japan coming out, talking about trying to maybe protect the yen, protect the currency. And you saw a big sell-off in long rates on that, combined with the tax cuts they had, the sales tax cuts. People are now worried about the deficit. They have one of the largest debt to GDP ratios out there. But at the same time, just like I wouldn't necessarily be shorting the dollar, I don't know if I'd be shorting the yen here. You're at one of the cheaper ends of the trading range, close to that one kind of 155, 160 area. Commodities rip roaring from that bottom in 2024 and a big pullback, largely driven by metals. We saw that the rally was largely driven by both precious metals and industrial metals, and we're seeing a reversal of that. But even with the 26% plus decline in silver, it's still up 20% on the year. Pretty remarkable. Gold still up 13%. Even got up to almost north of 5,500. Now it's sub 5,000 and still up on the year. Pretty remarkable. The rally in silver to start the year was just insane. Energy has been down last couple of days, still up 14%. So even with the weakness that we're seeing, it was the rally was so strong that we're still up on the year so far. Copper also giving back a lot too. Okay, let's talk about the economic data. So that this theme, this divergence that we're seeing, people rotating out of tech into industrials. Some of this has to do with the fact that there's stimulative things in the pipeline. Big, beautiful bill here. Japan's going to spend. Germany's going to do some defense spending. So here you can see that manufacturing PMIs flipped positive for the first time since 2022 in the U.S. Services also very strong. This is global manufacturing PMIs. Outside of China, you can see a big rebound, especially in the U.S., like we just saw, but solid manufacturing PMIs in all the developed nations, UK, US, Japan, Germany. These are some of the larger manufacturers in the world. Even the world PMIs globally north of 50. Services also strong, except China. China seems to be that one area of weakness that's out there, but the rest of the globe seems to be doing well. And this is obviously on a backward-looking basis. Now in the U.S., GDP estimates still strong. Atlanta GDP now 4.2%. And so while we did get a slightly weak jobs report with higher initial claims, some ADP numbers below estimates yesterday, I think economy is not in a recession. Earnings seem to be fine. So for now, things are humming along. We're just in this low fire environment that markets have been talking about. All right, let's go to rates. The 2-year has come down, been super stable because people don't think the Fed's going to hike. They don't really think the Fed may cut until after Powell's out. And so the 2-year has been in this very tight trading range, call it 350 to 360-ish, 365-ish. Same with the 5-year, pretty stable. But the long end's been underperforming. The 30-year Treasury yield almost back up towards 5%. The 10-year, I would say I'm neutral on it. It's super expensive at 375, 380, and that's kind of been the support. You know, it's definitely, it gets kind of cheap in the 450, the 475 range. Obviously touched 5% back in 2023. We're kind of dead smack in the middle of the trading range of the last couple of years. So it's hard to get super bulled up there. If anything, if the Fed balance sheet continues to unwind, maybe it actually pressures long end rates. And this theme you're seeing in Japan and globally about deficits and bond issuance. But I think that the Fed can, they can control short-term rates. So it's easier to be confident about kind of the 2 to 5 year portion of the curve, less so 10 to 30 year portion. So we like kind of shorter duration paper, add some credit spreads on top of that, and you can still create attractive portfolios. Yield curve has been steepening. We've had a steepener on in some of our portfolios. Put that on back in 2023. It's worked, but it's kind of going sideways now. So, you gotta wonder how much more room does this have to run? Will long end rates be supported by a change in Treasury issuance? Will the Treasury stop issuing longer end securities? They kind of have. They've kind of been issuing more on the front end because front end rates are lower, and so the cost of the debt will be lower. And it's funny because I think Besant used to make fun of Yellen for issuing so much on the front end, and he's doing the same thing. So, I guess once you're in the seat, you kind of got to do what you got to do. Break evens a little bit higher on the 2-year. I think this has to do with the spike in commodities, people's concerns of a reacceleration in growth. With that reacceleration growth could be some short-term reacceleration in inflation. However, longer-term inflation expectations still remain anchored. Still all these numbers sub 3%. It's just that 2-year number creeping up, maybe that's going to mean the Fed is going to aggressively cut. So I'm kind of in the Fed's not going to aggressively cut. They'll probably kind of do what the market thinks they'll do, which is maybe 2 cuts towards the end of the year. But I don't think we're hurtling into a depression or recession. Growth seems to be doing well. You've got the big beautiful bill. You've got fiscal impulse globally that will maybe help keep the economy humming along, which will be tough for inflation to come down. So maybe we're closer to neutral than we think. Fixed income returns, a whopping 0% return for the ag through last night. Really, it's been local currency with the dollar weaker that's had the highest gains, up 2.2%. Credit's doing well. High yields up 50 basis points. Triple B CLOs up 80 basis points. The longer duration stuff not doing as well. But, not a lot of negative returns, not a lot of positive returns. This is a earn your carry type market, is what I've been telling people. Like, spreads have come in a lot, but it's hard for corporate spreads to tighten too much from where they are. They're near historical tights. The securitized stuff we've been talking about will eventually play catch up. It's happening right now. Spreads and securitized are in. Here you can see spreads on everything are in except CMBS, out 4 basis points. Whoop-de-doo. High yield from really tight levels, not much tighter it can go. It's seen a little bit of weakness from its tights of the year with the vol in equity markets. Some of the concerns around software hitting the bank loan market, but securitized and agencies tighten the most. We had that announcement from the Trump administration that they're going to have Fannie Freddie buy $200 billion of agencies. That's helped spreads come in. So not a huge amount in nominal terms, 10, 12, 13 basis points. But, when you're starting with high quality assets that have spreads around like 100 or even IG spreads in the 70s, to move 5 to 10 basis points It's a 10% move for some of those asset classes. Here you can see corporate spreads near those tights going back to 2021. High yield OAS 264, IG 73, and agency mortgages. They were up in those. That's kind of like 70, 80 percentile. Now with the rally, they're kind of average. But if we're gonna try to get mortgage rates down, and Trump administration wants to support housing, they could get that spread tighter. So I think the agency mortgage market went from everything going against it, the banks not buying, money managers seeing outflows, this is back in 2022, 23, to things going for it now. The banks are back, they're buying, Fannie and Freddie are buying, Trump says he's going to tell them to buy more maybe, money managers are seeing inflows. So it went from everything going against it to kind of, there's support now. I think if spreads widen, you would see more support from the GSEs perhaps. So securitized, while it's not as cheap as it was, there's still some relative value there. That's kind of evaporating quickly. And so it's going to be a market where you got to be really patient in fixed income, and you got to diversify and try to find pockets of value. We still think these securitized sectors look cheap to corporates. There's some room to run there. But it's going to be all about earning that carry, and you got to avoid the defaults, avoid the losses. So risk management, diversification is super important. I joke that the easy money's made. The beta trade, just buying, HYG and spreads tightening, that's over. That was 2023. Now you really got to think about security selection. So we finally have some divergence, something to talk about. It was getting pretty boring through the end of last year and beginning of this year, everything going up. And this is kind of markets that are good for asset allocators. You can make some changes. So good luck out there, and we'll talk next month.